Have you ever felt that pull? The urge to maybe make your trading capital go a bit further, control a bigger slice of the pie than your cash allows.
Mm-hmm.
You've probably heard about using margin, borrowing from your broker. It sounds, well, exciting, right? Potential for bigger gains.
It definitely has that allure. But wrapped up right alongside that potential gain is some pretty significant risk. We're talking about the margin call.
Yeah, the dreaded margin call, that sudden demand from your broker that can just torpedo everything.
Exactly. It's that moment, when the cushion of equity in your account, basically what your stuff is worth, minus what you owe the broker, shrinks too much, below a critical level.
And understanding those levels, how they work, who sets them, and what happens if you fall below, it's not just good to know. It feels absolutely essential if you're going to trade this way.
Fundamental.
Yeah.
Absolutely fundamental for survival in the margin trading world.
Right. And that's our mission for this deep dive. We've dug into the source material you provided, the real nitty-gritty regulations from places like the Federal Reserve, FFIRA.
The key players.
Exactly. Plus, insights from financial experts, and really importantly, those raw, sometimes painful stories shared by actual traders.
Real world experience.
Yeah.
It matters.
It does. So our goal here is to unpack the core rules for using borrowed money in U.S. trading accounts. We're zeroing in on two huge concepts: initial margin and maintenance margin.
We'll get clear on what they mean, their roles at different points in a trade, how they're calculated,
Who sets the rules?
and crucially, why knowing the difference is so vital for managing your risk.
Okay, so get ready. We're going to dissect what trading on margin actually is, draw that clear line between initial and maintenance, look at what triggers a margin, call the mechanics and the sometimes terrifying reality, and then, most importantly, pull out strategies from the sources on how you can approach this whole thing safely. Or safer, anyway.
Sounds like a plan. Let's start right at the beginning then. What is trading on margin?
Good question.
At its core, it's about leverage. You're not just using your own cash.
Yeah.
You're borrowing either cash or sometimes even securities from your brokerage firm.
To buy more securities.
Right. And the assets you already have in your account, they act as collateral for that loan. It's like a secured loan, basically.
The sources use that mortgage analogy, which I think is helpful. Like buying a house, most people can't just pay cash up front.
Right.
The mortgage lets you control a huge asset, the house, with relatively less of your own money down. Margins similar for trading it lets you control a larger stock position, for example, than your own capital would normally allow.
And the main reason people do it, buying power to increase it, potentially amplify returns if the investment goes your way. If the stock price rises, your percentage gain gets magnified because you're controlling more shares than you paid for outright.
Makes sense. But it's not the Wild West, right? There are rules.
Oh, definitely. This isn't unregulated. Margin use in the U.S. is overseen by several bodies. The big one, the Federal Reserve Board, the Fed, they set the main rules through Regulation T, often just called Reg T.
Red tape, okay.
That governs how much credit brokers can extend to you for buying securities. Then you've got FINRA, the Financial Industry Regulatory Authority. They're the self-regulatory group for brokers.
Right, I've heard of them.
FINRA has its own detailed rules, especially around ongoing requirements, maintenance margin, account supervision. That's mostly in their Rule 4210. And the exchanges themselves, like the NYSE or NASDAQ, they have margin rules too.
So Fed, FINRA, exchanges, and then my broker.
And then your broker, yes. Critically, your individual brokerage firm puts its own rules, often called house rules, on top of all that.
And they're usually stricter.
Almost always stricter than the minimums set by the Fed or FINRA. Why? Well, they're managing their risk. They're the ones lending you the money, so they want a bigger safety cushion in case the market turns against you. Knowing your specific firm's rules is absolutely key.
Okay, so how do I even start? Can I just use my regular account?
No, you need a specific type of account, not just a standard cash account. You have to apply for and open a dedicated margin account.
And there are requirements for that.
Yes, minimum equity requirements.
Yeah.
The sources point this out clearly. Generally, to open and use a margin account, FINR says you need at least $2,000 deposited that can be cash or eligible securities.
Okay, $2,000 minimum.
But there's a big jump if you're what they call a pattern day trader.
Ah, the PDT rule.
Exactly.
Yeah.
FINRA Rule 4210 defines this, that basically if you make 4 or more day trades within 5 business days, and those trades are more than 6% of your total trades in that period, boom, you're a pattern day trader.
And the minimum equity jumps.
Skyrockets
Yeah.
to $25,000. And you have to maintain that $25,000 balance in the account at all times. It's a much higher bar.
Wow. Okay, so Get the margin account, meet the minimum equity, then what?
Then you sign the margin agreement. And this is crucial. It's not just paperwork. It's a legal contract.
What does it say, generally?
You're acknowledging the risks involved. You're agreeing to the broker's specific terms, including their right to liquidate your assets if things go wrong.
Liquidate. Like sell my stuff.
Sell your stuff, yes, without necessarily calling you first. You're agreeing that the securities in your account are collateral for the loan. It lays out the serious side of margin trading.
Okay. So let's be really clear then. This leverage.
It's powerful. A double-edged sword, as they say. Yes, it can amplify your gains, but it absolutely amplifies your losses just as much, if not more, if the market moves against you.
So you could lose more than you put in.
Definitely. It's a very real possibility. You can lose more than your initial investment. That's why generally margin trading is considered more suitable for experienced investors. People who really understand these risks and, frankly, have a higher tolerance for potentially significant losses.
Got it. That sets the stage well. Now let's get into the first big term, initial margin. You called it the entry ticket.
Exactly. Initial margin. This is the amount of cash or eligible collateral that you have to deposit into your margin account when you first make the trade, when you initiate a new position using borrowed funds.
It's the upfront down payment, basically.
That's a good way to think of it. It's the equity you need to commit right at the start.
And who sets the baseline for this?
The baseline for buying stocks comes from the Fed's regulation T. Reg G currently says the minimum initial margin is 50%.
50%. So if I want to buy $10,000 worth of stock on margin,
you need to have at least $5,000 of your own equity cash or other marginable securities in the account for that purchase. The absolute maximum you can borrow from the broker for that initial trade is the other $5,000, or 50%.
Okay, 50% minimum from Reg T, but you said brokers can ask for more.
Yes, and this is critical. Reg T is just the floor. Brokerage firms and FINRA too have the authority, and they often use it to set initial margin requirements higher than 50%.
Why would they do that?
Risk management, pure and simple. They look at the risk of specific stocks or maybe overall market conditions. Maybe a stock is super volatile.
Like a meme stock or something.
Could be. Or maybe it's a very low price stock, a penny stock perhaps, though the definition varies. Or maybe your account is heavily concentrated in just one position. Any of those things might make the broker say, okay, for this trade, we need 50% upfront or 70%.
So they want a bigger cushion from the get-go for riskier stuff.
Precisely. FINRA Rule 4210 backs this up. It says the required initial margin is the greater of the Reg T amount. Any other specific honorary requirements or whatever higher amount the firm decides is necessary because of the risk. And this also ties back to that $2,000 minimum account equity usually, meaning the initial margin for a trade covers that, but there are some exceptions.
So rule number 1 is check your broker's requirement for the specific stock you want to trade.
Absolutely. Don't just assume 50%.
Let's do a quick example from the sources. Say I want to buy $6,000 worth of stock. If the requirement is the Reg T minimum, 50%.
You need $3,000 in equity. You put up $3,000, you borrow $3,000. Your initial equity in that $6,000 position is $3,000.
Okay. But what if my broker says, nope, this stock is a bit choppy. Our house initial requirement is 60%.
Then for that same $6,000 purchase, you need to put up $3,600 yourself. That's 60% of $6,000. You'd only borrow $2,400. Your initial equity is higher, giving the firm that bigger initial cushion.
Got it. There was a bigger example too, buying $200,000 of Meta stock if it's 50% initial.
You need $100,000 of your own capital available for that trade. If the broker hypothetically required 60% for Meta, you'd need $120,000 up front. It directly impacts how much leverage you can actually use at the start.
What happens if I make a trade and maybe by mistake, I don't quite have enough to meet that initial requirement at that moment?
Okay. That can happen. Maybe you miscalculated your buying power.
Yeah.
If you execute a trade and it creates an initial margin deficiency, that triggers what's called a federal call tied to Reg T.
It's a federal call, and I have to fix it.
Yes. You have a set time to deposit the required funds or marginable securities. Historically, under Reg T, it was 4 business days from the trade date.
4 days. That sounds okay.
Hold on. That's changing, because stock settlement times recently shortened to T plus 1 trade date plus 1 day.
Right, I heard about that. May 28th, 2024.
Exactly. So consequently, the standard payment period for Reg T calls is shortening too. It's now 3 business days from the trade date. But, and this is important, your broker can always demand the funds sooner.
So maybe less than 3 days?
Could be. And if you don't meet that call by their deadline, the firm is required by the regulations to liquidate securities in your account to cover the shortfall. They don't have a choice.
Wow. Okay. Forced selling.
Forced selling. And briefly, just worth noting, rules for other things like futures contracts are quite different. Initial margin there can be much lower, maybe 5–10% sometimes.
That's huge leverage, like 10x or 20x.
Yeah, it is. But the flip side, as one source mentioned, is that futures exchanges can jack up those margin requirements very quickly, even intraday, if markets get wild. So calls can come fast and furious there too. Different game than equities.
Okay, so initial margin gets you in the trade. What keeps you in it? That's maintenance margin, right?
Exactly. You've put out the initial amount, you've got the position. Now, maintenance margin comes into play. This is the minimum amount of equity you have to keep in your margin account continuously to hold onto that position.
It's an ongoing check.
An ongoing requirement, checked constantly by the firm's risk systems, really.
Yeah.
Your equity, remember, is the current market value of your securities minus what you owe the broker on the margin loan.
And there's a regulatory minimum for this too.
Yes. FINRA sets the floor here. FINRA Rule 4210 mandates a minimum maintenance margin of 25% of the current market value of the securities in the account.
So my equity always has to be at least a quarter of the value of my margin stocks.
At a bare minimum, according to FINRA. But guess what?
Let me guess. Brokers usually require more.
You got it. Just like initial margin, that 25% is the absolute floor. Brokerage firms almost universally set their house maintenance requirements higher. Typically, you'll see 30% to 40%, according to the sources.
30 to 40%.
And sometimes even 50% or more, especially for stocks they see as particularly risky or volatile.
And how do they decide that? Is it just arbitrary?
No, it's based on risk assessment, often quite granular. As one source described, they might look at the individual stock, its price level. Lower price stocks often get higher requirements. Its volatility, how much it swings, how much is available to trade, liquidity, maybe even specific company news.
Okay. Or they might look at your whole account. Are you super concentrated in one stock or sector? How liquid are your overall holdings? If a stock is really illiquid or the company's in trouble, maybe facing delisting, that maintenance requirement could jump way up, potentially even to 100%, meaning you'd have to fully fund the position with your own equity.
Right. So again, need to know the broker's specific house maintenance rules.
Let's walk through an example again. Maybe that $6,000 position where I borrowed $3,000 initially. My starting equity was $3,000. Let's say the broker's house maintenance is 30%.
Okay. So the required maintenance margin dollar amount is 30% of the current value. Initially, that's 30% of $6,000, which is $1,800.
And my equity is $3,000, so I'm above the $1,800 required.
Yes. Your equity, $3K, is greater than the required maintenance, the $8K. You have a cushion. That difference, $1,200, $3,000 to $1,800, is often called your maintenance margin excess. It's how much your equity can drop before you hit trouble.
Okay, $1,200 buffer. But what if the stock drops? Say the $6,000 position falls to $4,000.
Okay, market value is now $4,000. You still owe the $3,000 loan. So your equity is now $4,000 minus $3,000, which is $1,000.
My equity dropped from $3,000 to $1,000.
Right. Now, what's the required maintenance at this new $4,000 value? It's 30% of $4,000, which is $1,200.
Okay. So my equity is $1,000, but the required maintenance is $1,200.
Exactly. Your equity, $1,000, has fallen below the required maintenance level, $1,200. That's the trigger.
Do the margin call.
For the margin call. In this case, it would be for the difference. $200. $1,200 needed minus $1,000 you have. You get a call demanding you bring your equity back up by $200.
Okay, that makes sense. The bigger example, the $20,000 stock purchase with a $10,000 loan, 50% initial, equity starts at $10,000 if the house maintenance is 30%.
Required maintenance is initially $6,000, 30% of $20K. Your $10 equity is fine. Cushion is $4,000. Now say the value drops to $14,000.
Look at value $14K, still owe $10 loan, equity is $4,000.
Right. What's the maintenance needed now? 30% of the current value, $14,000. That's $4,200.
So my equity is $4,000, but I need $4,200.
Bingo, you're $200 short. That triggers a $200 margin call.
It's really important to get that the dollar amount needed for maintenance changes as the stock price changes.
Absolutely critical. It's not a fixed number. It's a percentage of a moving target, the current market value. When the stock goes up, the dollar amount needed goes up too, but usually your equity goes up faster, so your cushion grows.
But when it drops,
that's the danger zone. The dollar amount needed for maintenance drops too. It's 30% of a smaller number. But your actual equity is falling even faster because that fixed loan amount is taking a bigger bite out of the shrinking value. It's that gap closing, your equity falling below the moving threshold, that rings the alarm bell.
And the whole point of this maintenance margin, fundamentally, it's not really for my benefit, is it?
Not primarily, no. As the sources stress, it's there to protect the brokerage firm. It's their safety net. It ensures there's enough collateral left in your account to cover their loan if things go south quickly. It reduces their risk of losing money if your investment tanks.
Which leads us right into the scary part, the dreaded margin call, when that protection mechanism kicks in.
Yeah, so a margin call, simply put, is that formal demand from your broker. You need to put more money or securities into your account now
To get the equity back up.
to or above that required maintenance margin level. It's the signal that your safety cushion is officially too thin for the firm's comfort.
And the main trigger we saw is the market value dropping, pushing equity below maintenance. That's the most common one.
By far the most common. But there are others. We mentioned that federal call if you had an initial margin shortfall from the start.
Right, trading for more than you had.
And the third one, which can catch people off guard, is when the brokerage firm itself raises its house maintenance requirements.
Even if my stock price hasn't changed.
Even if the price hasn't moved, if they suddenly decide a stock you hold is riskier, maybe due to crazy volatility, bad news, liquidity drying up, they can just increase the maintenance percentage required for it. And that action alone can trigger a call if your equity was close to the old limit.
Wow. Okay, so this is where it gets serious. The broker's rights when a call happens. What did the sources say? It sounds pretty stark.
It is stark. And you need to understand these points, which are usually right there in the margin agreement you signed. First, they generally are not required to warn you as your equity gets close to the maintenance level. Courtesy alerts. Maybe. Required warning? Usually no. Monitoring is on you.
Okay, no hand-holding.
Second, and this is huge, they are not required to give you a formal margin call before they start selling your securities. If you fall below maintenance, they often have the right to start liquidating immediately without notice.
Sell first, ask questions later.
Potentially, yes. Third, if they do liquidate, they choose what to sell, not you. They can sell any securities in your account, profitable ones you wanted to keep long-term, doesn't matter. Often they'll sell whatever is easiest or what they deem riskiest.
I don't get a say.
Generally, no. Fourth, they don't just have to sell enough to meet the margin call amount. They have the right to sell enough securities to pay off your entire margin loan. They can just wipe the slate clean, debt-wise, by selling your assets.
Whoa, okay.
And fifth, this can happen fast. We're talking real-time margin systems. If your account dips below maintenance intraday, the selling could start almost instantly. You might not even know what happened until after the fact.
And if they sell, I bear the consequences.
Oh, absolutely. You, the investor, are responsible for any losses incurred during that forced sale. If they have to sell into a falling market at terrible prices, that's your loss. Plus, you'll likely owe commissions on those forced trades. That Reddit user's comment about the firm selling a whole lot of my stocks at a crap price, that's the painful reality.
So what if? What if the selling isn't enough? Like the market gaps down overnight, huge drop, and even selling everything doesn't cover the loan.
That's the nightmare scenario. And it does happen, though firms try hard to avoid it. Your account can go into a net debit balance. You actually owe the brokerage firm money.
And they'll come after it.
Oh, absolutely. That Reddit comment, they absolutely come after you for the money, is spot on. If you can't pay that negative balance, they will send the debt to collections, which means serious trouble. Damaged credit score for years, making it hard to get loans, mortgages, even rent an apartment sometimes. Potential lawsuits from the broker to recover the debt. And even wage garnishment, where they can legally take money directly from your paycheck. That comment about state formulas taking almost everything, it can be devastating.
So even though brokers manage risk tightly, these extreme events can leave the trader owing significant money.
Yes. Fast market moves, especially those overnight gaps where you can't trade out, can blow through equity and margin levels before anyone can react. That Tastyworks example mentioned where the firm supposedly ate a $2 million loss shows it can happen, but you should absolutely assume they will pursue you for any debt you owe them. They are just going to let it go.
Okay. Dire warnings understood.
Yeah.
Let's say I get a call. I need to act fast. How do I actually meet it? What are my options?
Right. The FICA NRI source lays this out the simplest way. Deposit cash. If it calls for $200, send $200 in cash to the account. Done.
Okay, cash is king. What else?
You can deposit more margin-eligible securities from outside the account. But here's the catch. You have to deposit more value in securities than the cash call amount.
Why is that?
Because securities themselves have margin requirements. They aren't treated like 100% cash collateral. The formula provided is market value of securities needed equals margin call amount. 1 house margin required percent.
Okay, let's use our $200 call example and say the house maintenance is 40%.
Right, so you'd need to deposit $200, $1.04. $200.60 counts towards $333.33 worth of eligible securities, because only 60% of the value of those deposited securities counts towards meeting the maintenance requirement in that scenario.
Got it. Deposit more value in stock than the cash call. What's the third option?
Sell securities already in the account. This raises cash and increases your equity percentage. But again, the amount you need to sell is different. The formula is market value securities need, margin call amount, house margin requirement percent.
So same $200 call, 40% house requirement.
You'd need to sell $200.40 towards $500 worth of securities currently in the account.
Wow, I have to sell $500 worth to cover a $200 call.
Yes. You have to sell significantly more value than the call amount itself when you're selling within the account. The math works out that way because selling reduces your total assets while generating cash.
Okay. Cash, deposit more securities or sell existing securities, selling more than the call amount. Those are the ways.
Those are the main ways. And sources sometimes differentiate between federal calls for initial margin issues under Reg T and house calls for dropping below the broker's maintenance level. The required action is similar, but the origin is slightly different.
Okay. So given how fast this can happen, how severe the consequences are, and the power the broker has, how do you even attempt to trade margin safely? How do you manage these risks?
Well, the absolute first step, echoed everywhere, is to get rid of any idea that this is like a friendly personal loan. It's not. There are no grace periods, no negotiating payment plans when a call hits. The broker's protecting their money, and they will act fast. As one user said, they can't take the risk that collateral will fall further.
So, step 1, respect the seriousness. Step 2 must be read the fine print.
Absolutely. Read and understand your specific brokerage firm's margin agreement. It seems boring, I know, but it's the contract that gives them the right to liquidate your assets without notice. It spells out the terms, the risks, how collateral works. Don't sign it blindly. Ask questions.
And know their specific rules, not just the regulations.
Yes. Don't just rely on Reg T 50% initial or FINERA 25% maintenance. Find out your broker's precise house initial and maintenance requirements. Especially for the types of securities you trade. How do they calculate them? Do they change them based on volatility? What's their actual procedure for handling calls? Do they try to notify you? How fast do they typically liquidate?
And know that those house rules can change.
Critically, yes. They can change those house requirements at any time without prior notice. It's usually stated right in the agreement. The ground can shift under you.
Which means you have to watch your account like a hawk.
Constantly. Diligent monitoring is non-negotiable. Check your equity level, check the market value of positions regularly. Maybe multiple times a day if things are choppy. You need to know precisely how close you are to that maintenance threshold. Don't let a margin call be a surprise.
The maintenance margin excess concept seems useful here. Knowing your buffer.
Exactly. Track that number, the amount of equity you have above the requirement. It tells you exactly how much your portfolio can drop before the alarm bells ring. A bigger excess equals more breathing room.
And use broker tools. Alerts.
Definitely. Most platforms let you set custom alerts. Set one based on your equity level, maybe comfortably above the actual maintenance threshold. That way you get an early warning, giving you time to think and act before a first situation develops.
And have a plan before the call comes.
Crucial. If you're trading on margin, you must have readily accessible funds, cash, or other marginable securities sitting outside that margined account, ready to be deposited instantly if needed. Don't be like that Reddit user hoping their paycheck arrives in time. The broker's clock ticks much faster. Hours, maybe a day or two for a federal call, not weeks.
What about managing the risk within the portfolio itself?
Smart strategies help. Diversification is important. Don't concentrate all your margin borrowing in one super volatile stock. A plunge there could trigger a call that forces liquidation of everything else.
Using stop losses?
Can help, yes.
Sure.
Protective stop-loss orders might help limit the damage on a position before it drags your whole account down towards a margin call.
And just don't borrow so much.
Fundamentally, yes.
Yeah.
Use manageable leverage. Just because you can borrow 50% doesn't mean you should. Borrowing less, maybe only using 10% or 20% leverage, gives you a much larger initial equity cushion and makes it far less likely you'll hit the maintenance floor during normal market swings.
And for options traders?
The sources suggested defined risk strategies. Things like credit spreads or debit spreads, they have limited loss potential built in, so the margin requirements are predictable. Much safer than naked short options, which have theoretically unlimited risk and can lead to massive, unpredictable margin calls.
Good advice. What about practicing first?
Excellent idea mentioned in the sources. If you're new to margin or just new to a broker's platform, use their paper trading account first. It's simulated trading with fake money. You can see exactly how buying power changes, how requirements work, how calls might trigger, all without risking a dime of real capital.
Learn the mechanics safely.
Exactly. And finally, remember the simplest option. Trade in a cash account. If you only use the cash you actually have, you completely eliminate the risk of margin calls and losing more than you invested. It's always an option, especially for newer or more risk-averse investors.
Okay, a lot to cover there. Let's try to wrap this up with a quick recap. Initial margin, that's the down payment to get in the trade. Reg D says 50% minimum for stocks, but your broker probably wants more.
Right. And maintenance margin is the minimum equity percentage you have to keep in the account ongoing.
Okay.
Fangui says 25% minimum, but again, your broker's house rules are key, usually 30-40% or higher.
A margin call happens when your equity drops below that maintenance level.
And when it does, the broker has serious power, crucially, the right to sell your assets, potentially without warning, to cover their loan.
So understanding the rules, knowing your broker's specific policies, and watching your account like crazy are the best defenses.
They really are. Against being blindsided by a call and facing those harsh consequences, forced losses, owing money, collection agencies.
So the action item for you, the listener, is clear. If you use margin, or even think about it, dig up your broker's margin agreement and their specific house requirements. Read them, understand them, know the triggers, the procedures, how they communicate calls, or don't. And then monitor.
And that leaves us with maybe a provocative thought to consider. Given that your broker has this legally backed power, this swift, potentially unforgiving right to liquidate your assets without notice to protect their loan, and you could still end up owing them money and facing collections, what does that power dynamic really say about the partnership you have with them when you borrow funds? How does that reality factor into your personal risk assessment? How much leverage, if any, are you truly comfortable with, knowing those are the stakes?
It definitely changes the frame from just making money faster to a much deeper conversation about risk, control, and potential consequences. A really important perspective.
Well, thank you for joining us for this deep dive into initial margin and maintenance margin.
We really hope breaking down these rules and realities has provided some clarity and helps you approach margin trading, if you choose to do it, with the caution and preparedness it demands.